Hi, I'm John Mark Young, President and Chief Investment Officer of Whitaker-Myers Wealth Managers, and I'd like to welcome you to another edition of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week video. Remember, our aim is to provide you, our valued clients, with a brief video giving you information that is helpful to your understanding of the markets from a biblical worldview with no financial agenda, which of course makes us uniquely different from the news media in America. This video is for informational purposes only and should not be relied upon to make any sort of investment decisions. And the clients of Whitaker-Myers Wealth Managers may maintain positions in the securities discussed in today's video. All opinions discussed are solely those of John Mark Young and not those of Whitaker-Myers Wealth Managers. So let's talk about the 4 things we learned in the markets this week, starting with point number 1. Point number 1 was this was a pretty quiet week in the markets. Maybe the quiet before the storm, because next week there's a lot of data coming out and a lot of things going on. On Tuesday, the U.S. inflation rate will be released for the month of May, the CPI. Wednesday, the Producer Price Index will be released, PPI. All this while the Federal Reserve will be holding their FOMC committee meeting. The outcome of the markets for the month of June most likely rests on the data that we'll receive next week and how the Fed reacts to that data, plus everything else they've learned so far this last month and a half. This week, the stocks to watch were mainly technology stocks, again, including Tesla, who jumped last week after announcing a partnership with Ford to soon begin charging Ford electric vehicles with their charging ports. And now, starting in a few years, they'll be offering the same charging services to those who purchase a General Motors electric vehicle. That was announced this week. In addition, chip makers, NVIDIA and Advanced Micro Devices, they had pretty good weeks thanks to continued investor interest in anything that has anything to do with artificial intelligence. This week, we also received the Case-Shiller Home Price Index. Another word soup, but this is the report that tells you from a national level, is your home price going up or going down? While you can see the index is down from a year earlier, it did make a little bump in the most recent reading. If you ever want an interesting study on human behavior, use your house versus stocks as an example. Your stocks, you tend to freak out when they drop. That's okay. It's human nature. You just shouldn't act upon that emotional reaction. As you can see here, your home price does the exact same thing. It goes up, it goes down. The difference is, and I'm the only one telling you this, you're not getting a statement each month from Charles Schwab on your house. Thus, you don't freak out about it. The lesson here is this. The lesson is this. If your investments create too much emotional distress in your life, check in with your advisor or planner as often as you feel you need to, and don't watch it every statement, every month, every day. It'll give you a heart attack, and then all your savings habits you've had your whole life were for nothing. Rant over. Now, let's look at my favorite report, the weekly claims for unemployment insurance, which is one proxy I use for my recession indicator. When the job market starts to falter, then I'm more receptive to discussions around a recession. And what you can see is we did take a spike up this week, hitting 261,000 new claims for unemployment insurance, which matches a one-year high we saw in July of last year, July 16th. So perhaps this is just a seasonal swing or back to more a normal level of unemployment claims, but it's only 1 week. So we're going to continue to watch this. 1 week can't create an outcome. And finally, let's look at the returns of the market last week, the S&P 500, which of course is our proxy for growth and growth in income, but only when taken together, not independently. That was positive 0.39% this last week. The Russell 2000, which is our index for smaller and mid-sized companies, or aggressive growth in our Dave Ramsey vernacular, that was positive 1.63%. And finally, the MSCI EAFE, which tracks international stocks, that was actually negative 2.22% for the week. Point number 2, who knows the saying, red sky at night, sailor's delight? Well, this is basically born from the fact that when there's a red sky, it's showing a red sky because as the sun sets, it's sending light through a high concentration of dust particles, which is typically because of high pressure and stable air, which ultimately means if you're a weather person, a meteorologist, good sign for good weather to come. In the very same way, our red sky for the stock market is called the CBOE VIX. This gauges a 30-day projection of volatility based on the prices of indexed options, in this case, index options on the S&P 500. This can be seen as a way to gauge market sentiment and or fear in the market. As you can see, not only is it lower this year in 2023, but look at it today relative to the last 5 years, It's recently closed at its lowest level since February 19th of 2020, which is obviously the lowest level since the start of the pandemic, a very notable milestone in my opinion. To give a little perspective, since 1990, the average rate of the VIX is 19.7 with a standard deviation of around 7.9, which means hitting 11.8 on the downside would be a considerable level to watch because that's one standard deviation. The question to consider is, will these levels hold? If it does, and we're back to a situation like we had in 2018 through 2020, when we had 208 trading days that were all below a 14.6 or right around 14.6 VIX level, and even 11 days where it did hit that one standard deviation of 11.8, that's a good sign. 1 week sitting here is not signaling anything yet, but it's certainly something to watch and might be the market telling us that economically, we are closer to the end of the economic shock effects of the pandemic that were thrust upon us in the last 2 to 3 years. Point number 3, Apple stock is a stock that many investors own. You either own it as a core holding in your portfolio individually, or if you don't own it individually, many of our Ramsey Solutions fans are not going to hold it individually, but hold it in a more broadly diversified mutual fund. It's typically a top holding in your growth fund, and it's typically a top holding in your growth and income fund, thanks to the fact that it's growing so much and it's got a nice dividend. This week, they announced their highly anticipated augmented reality headset. This got my friends at DataTrek thinking about how Apple stock has performed during product announcements in the past. What they did is this. They looked at Apple's performance prior to and after every new product segment announced, dating back to the early 2000s. Those product announcements were, let's take a trip through history, the iTunes Store and the iPod in 2001, the Apple TV in 2006, the iPhone in 2007, the iPad in 2010, Apple Watch in 2014, AirPods in 2016, and the HomePod in 2017. As you can see from your screen, DataTrek took the returns of Apple versus the S&P 500 and the NASDAQ, the 21 trading days leading up to the announcement of Apple products, basically a month. And as you can see, about 75% of the time, Apple had a positive win rate with an average return of 6.9%, besting both the S&P 500 and the NASDAQ in both win rates and rate of return. If you're wondering how Apple has done in the last 21 days leading up to this announcement, the augmented reality headset announcement, they're up 8.3%, so slightly better than the average. Then they look 3 months after the announcement. And amazingly, Apple has never declined in the 3 months following an announcement of a new product segment. Its average return has been around 16% with a 100% win rate, while the S&P 500 and NASDAQ have both come in around a 2% positive range with an 88% win rate. Their win rate, no doubtedly, being helped by the fact that Apple is one of the largest weights in both of those indexes, the NASDAQ and the S&P 500. But we don't typically make individual stock recommendations. This is good news for the broader market, considering that Apple does make up 7.5% of the S&P 500. 500 companies, but Apple, one stock, is 7.5% of it, which is the same weight that the entire sector of real estate, materials, and utilities make up when you add them together. Apple, bigger than those three sectors combined. When Apple does well, the market does well. CNBC reporter Steve Kovac tested the Apple Vision Pro headset, and his analysis was incredible and fun to read on many fronts. And he has me incredibly excited about the future of this technology. I'm going to put the links in the comments of this video so you can read that yourself. And point number 4, let's talk about the latest GDP Now forecast, which is still pretty upbeat about the U.S. economy. In its latest estimate, it's calling for about a 2.2% real GDP number in quarter 2. And this generally accurate data point put out by the Atlanta Federal Reserve has been pretty consistent with its calls for 2 to 3% growth since the start of May. Let's pair that data with information on U.S. gasoline demand from last week's Energy Information Agency's release, and we can see the blue line, which is 2022 through 2023 gasoline demand, versus the year prior, which is the brown line, that demand is 2% higher than a year ago and back to levels at the start of last year. Moreover, year-over-year comps have been positive since March of this year, so consistently beating last year. The lower prices we see now are certainly helping this, but look back at any sort of recession or any sort of slowdown in the economy, and low prices actually don't help gasoline demand when the economy struggles. You still have low demand when the economy is struggling, regardless of price. Additionally, considering that return to office is not in full play yet, we can assume that most of this demand is for discretionary travel, which goes right along with the GDP Now model data I just talked about above, which is saying the American economy continues to roll along, thus no recession yet. We talked about the jobs number last week, 339,000. Many economists said once we got that job number, it's hard to have a recession with that many jobs. That many jobs typically pushes your recession back 6 to 12 months. So again, in the near term, we're saying jobs data says no recession. Thanks so much for watching this week's video. If you like the information you received in this video, would you do us a favor? We've got a trick Google and YouTube's algorithms to let them know a Christian-based financial planning firm should get likes, looks, all kinds of things on YouTube and Google. So you can help us by hitting the like button. When you smash that like button, that tricks their algorithm into thinking our content is some of the best. We think it is. We'll see. But hit that like button, and that gets our content out to more people. And hit the subscribe button. The subscribe button allows our content to be pushed to you right when it's released. Additionally, if you like to watch these videos, you can watch them now on the Rumble platform. Just search Whitaker-Myers Wealth Managers on the Rumble platform, and our videos are all being streamed right on Rumble as well too. So you can check it out on YouTube, Rumble, your video watching service of choice. We're on both today. If you would like to meet with any of our financial coaches, and our financial coaches are folks that help you get out of baby steps 1, 2, and 3, you can hit the link in the comments. That link will take you right to our scheduling tool where you can schedule with any of our financial coaches to help you get through those first baby steps so you can get it on a plan to live and give like no one else. If you're already in baby steps 4, 5, and 6, we'd be more than happy to help you start executing, start getting an old 401k rolled over, whatever you need to start moving yourself forward towards baby step 7. Hit that schedule button and you can schedule with any of our financial planners. Thanks so much. We'll look forward to seeing you next week.